Hey guys, you're listening to Tax Tuesday. This is Toby Mathis,
And Jeff Webb.
and we got a lot to go over today. You guys are saying hello. Hey, tell me where you're from. If you're in the question area, you may as well just tell me. Hey there, Sherry. Hey Sherry, good catch on the date, by the way. Sherry called you out, Susan. Just so you know.
Thanks, Sherry. Appreciate
it. So just to foster goodwill, we're only going to be talking politics tonight. And we're going to take whatever position you are against. No, let's see. Colorado, Virginia, Denver area, Houston, San Francisco Bay, Spokane, Washington, Graham, Vancouver, North Carolina, Al from Hawaii.
No Russian hackers.
Yeah, you get some bots. What a bot farm. San Jose, Jim from Philly. Oh, wow. Hey, Jim. You guys got your hands full there right now. Nebraska, Texas, New Jersey, Wyoming, Florida, Sacramento, Austin, Chicago, Alameda, Sacramento, Anchorage, Charlotte, North Carolina, some more Florida, some Tennessee, Seattle. I was just in Bellevue over the weekend. Got to have some civil unrest in the middle of Bellevue, which is really weird because Bellevue is about as mellow as they come. Arlington, San Francisco, San Antonio, so Ontario, Katy, Texas, Fremont, California. Hi, Tim. Smoky, California, Utah. So we got people from all over the place. So we got a pretty good group tonight. No, we're not going to talk politics. Last time I got to go over the difference between the candidates' tax plans. Frankly, their positions tend to change. I would say nightly, but I think it's more often than that. So no, I'm just teasing. No, there will be some things that we have to address depending on who. I've actually had some clients come in with some pretty drastic tax plans in absolute fear of what would happen to their estate if the step up in basis and the estate tax went away. And so they were about to take actions, and I kept saying, whoa. You know, there's some trust lawyers out there that are really pushing people. So it's kind of going crazy. The market is historically really volatile, right? Going into the election and then immediately smooths out. So what would I be doing? Probably sitting on my hands a little bit. I don't think I want the volatility. If I'm going to buy something, it's going to have nothing to do with the presidential election. I'm going to buy something that I think is a good company at a good value. Maybe I'll look to see if there's any dips. But that's about it. All right. So you could ask your questions in the question and answer. You could see I'm already reading them. Jeff reads through them. We all read through them during the event. We also have Pio Sam on here he's CPA. We have Tavia, the bookkeeper, Elliot, tax attorney. Is Elliot a CPA? I always forget.
No, he's not.
He's going to be someday, but
if you are Elliot, sorry.
So Elliot, we still love you, even if you're not a CPA. And I always say CPAs are like pitchers in baseball. You need to have them. You guys are whack. You guys, no offense, Jeff, but
sometimes we get books from what we call the crack pipe accountants, CPAs.
I was looking at it like I remember old Lou Piniella. Some of you guys have heard me say this, but I was up in Seattle when the Mariners won 116 games. That's a big thing. And man, he hated his pitchers. He would get up there and he would just look worked, and he'd be like, "Oh my goodness." Well, questions already sent in be answered. We answer those, Melanie. When we receive them, we're kicking them off and making sure that they're answered. So if you haven't received answers, sometimes they flag them to be answered live. So we'll see. If you don't get an answer, we will make sure that we get it answered. Just let us know. Say, hey, I asked this last time. Every now and again, we get hundreds of questions. And our guys are really good about trying to reach out and getting them answered. But just in case. Let's see. There's a few questions that are already coming in, but we will we'll just wait for a second before we get diving into those. If you do need a very detailed response, like some of you guys write books, call them books because I start reading them and they'll take up half the page. And the way GoToWebinar and GoToWebinar is really what we're using tonight. The way Zoom and these things work, it'll just suck up the whole page.
Mhm.
So it's like those ones we may need you to email in. It's only so many. It's like Twitter. Somebody has one of those 20-page, what do they call it?
Dissertation.
No, but they'll do it and they'll be like, it's just a thread. There we go. It's like this long thread on Twitter.
Hey, a comment on these tax plans that are the candidates are coming up with. What is presented isn't always what happens. And a good example of that was TCJA.
Tax cut and jobs, yeah.
Back in 2017, which
Mhm.
changed drastically within weeks of it first being prepared.
That's because presidents don't write laws. You still have the House, you still have the Senate, and the president really has nothing to do with the bill. They may say, I'm going to veto it, so don't pass that version, and then
Mhm.
work with them. But, for the most part, it's good. It's everybody makes promises. This president, whether you like him or not, is honored a lot of them, and some of them no. Some of them are twisted ways of saying, yeah, I got there, but on the same token, a lot of them just say things and then never do them. So I don't know what we're going to get this time. Trump hasn't really done much on the tax side other than saying he's going to try to focus on the middle class, opening some of that up. The regulations do. The lowering of corporate taxes do help the middle class. So we've seen incomes go up. If you doubt me, go look at the Federal Reserve, the St. Louis Federal Reserve economic data. You can look and see household incomes. They've gone up considerably the last 4 years. All right. So let's go opening questions. Then we'll answer some of the questions that are up here. Number one, I'm a computer engineer in California with a $350,000 salary. So way to go. This year, I got an extra bonus of about $100,000. Also received $70,000 short-term capital gains. Under these circumstances, is there anything we can do by the end of the year to still save on tax? So we'll answer that. One beneficiary IRA became self-directed IRAs. So one beneficiary IRAs, I guess it's plural, became self-directed IRAs to purchase rental properties. We are of retirement age, but don't have to take RMD yet. So that sounds like they're between 65 and 72. Can we convert the self-directed IRAs to Roths? Our goal for this year is to pay 12% taxes on AGI. That percentage might increase in future years. So we'll answer that. I'm a high income earner and we have short-term rental in service for December 2020. So it's coming up. In order to take advantage of the tax benefits. So they're going to put it in service before the end of the year.
Mm-hmm.
Would you recommend cost segregation this year and use losses towards active income? So we'll delve into that one a little bit. I have residential property that I will lose next year. Can I write it off this year instead to minimize my owed taxes? This property is a small lot that I bought for $65,000 cash 15 years ago. Now the property is encumbered by property tax liens and lot cleaning liens. So it sounds like they just let it sit there for a while. So we'll dive into that one. What are your thoughts about the tax incentives given under Act 20 and 22 in Puerto Rico? The caveat I understand is that you must be a bona fide resident of Puerto Rico in order to get the tax incentive. It almost sounds too good to be true. Can the U.S. federal government stop this at any time? We'll go through that. How can I take a deduction on my taxes for working from home? I use a portion of my bedroom to work online. I had to upgrade my computer and internet speed. So we'll go through that. If we are part of several syndications, and syndication is just a group of investors, can we deduct requirements to be a partner of the syndication and other expenses for being part of the syndication? In other words, it sounds like they have certain expenses that they have to incur to be part of the syndication. Deductions expenses such as meetings, seminars, publications on syndications as ordinary necessary. Chances are as ordinary necessary expenses. So we'll dive into that one. That'll be an interesting one. My wife and I own over 10 rental properties, and we are also passive investors in several multifamily syndications. 8 of the rental properties are managed by a property manager. How easy is it for my wife? So how can easy? How easy? By the way, I just grabbed these from the questions that come in. So sometimes you guys see there's typos and stuff. I literally just grabbed whatever's flagged, whatever looks really cool, and I grab them and just cut and paste them. So sometimes I'll do a quick edit if it's really long, but otherwise I'm not touching these. How easy is it for my wife to qualify as a real estate professional while essentially being an asset manager on them? It's a good one. We'll answer that too. Oh gosh, Toby must have gone crazy again. We still have more questions.
It's not really that bad, Toby.
What is the difference between short-term and long-term capital gains, and the difference between owning the property in a personal name or an LLC with regard to capital gains tax? Is it always going to be like ordinary income? What are the warnings and limitations of investing in real estate through the use of a self-directed IRA or a solo 401k? There is a limitation if the deal is leveraged, correct? So we're going to go through all of that. And then the last two questions, I promise. Guys, you guys send a lot of questions, and it's like Halloween candy. You don't just pick one. All right, I am sitting on about $250,000 of equity in a rental property that is paid in full. What are my options to get the money out and in an active investment, such as an LP in a syndication or something to unlock their growth potential? It's funny they say active investment in a limited partnership. I don't know. I think it's funny. What would you recommend as a business entity for a private music studio for instrumental education for maximizing tax benefits to allow deductions for home office, mileage, instrument care, maintenance, etc.? So that's good. Lots of questions. Oops, let me go back in. I just clicked too fast. There's a few questions you guys are already getting there, and somebody said something nice about Patty, so you're already suspect. Patty is really cool. Looks like, wow, you guys are already hitting a bunch of it. Where can I find CPAs that specialize in real estate? I wanted to make sure that I'm getting all the benefits of having a real estate process. You are in the right place. That is what we do. How many returns have we done so far this year, Jeff?
Last count about 6,030.
You give an account now. You can just say over 6,000. You like to say 6,000.
I'm an accountant.
You're so precise. You're so precise. All right. So it sounds like a bunch of people are already getting it. How would the Puerto Rico Acts? We're already going to get that. I'm a realtor in California. Would I have to pay California state tax and Puerto Rico state tax? You can't have two houses. So we will dive into Puerto Rico, the Act 20 and 22, but you have to be a resident there and you can't have a resident elsewhere. I'm just going to dive through. Let's just jump for some in. We have so many questions coming through. Let's see. Other than short-term, long-term, do capital gains increase by levels? So short-term, there is no short-term capital gains.
Capital gain rate, right?
Yeah, it's just your ordinary tax. And yes, that increases by your tax bracket.
Mm-hmm.
Long-term, there's really three levels: 0, 15, and 20%. And if you want to be technical, by the time you get to the 20% and a good portion of the 15%, you also have the net investment income tax.
Correct.
So, and then you have your state tax. So everybody always says 20%. It's really 23.8. And it's really, depending on your state, like California, some of you guys are saying you're from California, you could be as high as 36.8, 13% on top of the 23. So you could still be pretty high.
And they're the ones talking about adding a 16% bracket
Yeah.
for all you people who make more than 30 million a year.
Yeah. 30 million, then we're really going to get you. Is there income limit to contribute to a traditional IRA and take a deduction for it? On a traditional IRA?
It's going to depend on whether you're you or your spouse is qualified or eligible to be in an employer plan.
Yeah, there's always a little one. I'm going to look and see. I have all my little, well, this is 2019. That's not going to help me.
Yeah, it's close enough.
Let me see. Qualified plans, IRAs. There we go. Limitation. Your income limits are really on your Roth. where if you're over about 200,000 married filing jointly, you're going to phase out, but there's no phase out for a Roth 401k. And then traditional Roths, let's see, there are some phase outs depending on what you're doing. Your modified adjust and whether you have another plan. If you don't, then I don't think you have to worry. If you do, or your spouse has a plan, then there's weird phase outs. If you're single, it goes at 74,000 or thereabouts above, you're out. If you're married and one spouse is covered, then I think it's like it's over 200,000.
Yeah, this is a good example of an area that Congress took a simple answer and made it really complicated.
Yeah, what we usually do is go to things where there's no limits, period. So you're going to go to your 401k. And if you want to put money in a 401k, one of the things we do go over, and this isn't going to be the place that we're going to do it because it gets a little complicated, but you can get $57,000 a year into a Roth 401k if you want, no matter how much, like as long as you're making a lot of money, I guess I could say. So it does matter how much you're making, but you don't have income limitations. So somebody else asked, then we'll dive into the questions. I just began working as a 1099 position as a real estate assistant. I don't have a business account set up. Will this negatively impact me? Do I need a business account? So Shannon, you don't necessarily, like the way that you're being treated right now would be considered a sole proprietor. Will this negatively impact you? I mean, it can, only from the standpoint of sole proprietors are known by the IRS as overstating their expenses and understating their income, so they have a high audit rate. But it's not going to hurt you. Really, where it starts to hurt you to be acting as a sole proprietor is when you make over $30,000 a year. Before that, it's not horrible. And you will be able to take expenses against it. So I would recommend that you join us in one of our classes. I think I did a webinar not that long ago on sole proprietors, and I crunched the numbers and I show you kind of where the lines are to where you may want to consider being an S corp versus a sole proprietor. But Patty, if you can drum that up, maybe.
Yeah, I mean, I agree with that. You don't need separate accounts, but you need to separate your business expenses. The other thing I was going to suggest, though, is if anything they're doing as a 1099 person can give them any kind of legal liability.
Yeah, I mean, when you're acting as 1099, you're a business. And anything you do in that business, you have personal responsibility for, unless you put a box around it.
Yeah, so you want to consider protecting yourself from your business.
Right. And a box would be an LLC or an LLC with tax as an S corp or an S corp or a C corp or an LLC tax as a C corp. Like there's several flavors. If you want the best answer, it would be to reach out to our guys and let them sit down and get to know your situation a little bit more. They won't charge you for it. They'll just give you a blueprint and tell you, here's your options. There is a big difference from a tax standpoint once you get over, start making some money. So we can get it. Somebody says sorry, Patty, to throw that out at you. It was the solopreneur. I think I did it like 3 months ago, 2-3 months ago. My brain is Swiss cheese right now. Somebody's asking about Tax Tuesdays. They already got that. All right, let's dive into some of the questions so we're not here until the wee hours. I'm a computer engineer in California with a $350,000 a year salary. This year I got an extra bonus of $100,000, also received $70,000 short-term capital gains from investment. Under these circumstances, is there anything I can do by the end of this year to still save on tax? Jeff, what say you?
Well, I'm going to give you two easy ones. One we've kind of already talked about, and that's maximizing your retirement plan contributions. Mm-hmm. If you're over age 50, is it 50 or 55?
For which one?
For the 401k, you 50. Can 50. You can put away $24,000 out of your 401k. Mm-hmm. My second suggestion.
More than that, actually, it's
is it
26,000 plus 19,000.
Oh, you're right.
So it's 25,500.
It's a bunch of money. My second suggestion, you talked about having short-term capital gain. If you have capital losses you can harvest, And by harvest, I mean you're selling lost positions and not replacing them for at least 30 days with the same investment. You can offset those short-term capital gains, even if it's with long-term capital losses.
And Jeff is nailing the nail on the head, it's hammering the nail on the head. Any capital loss will offset capital gain. So even if you have long-term capital gain or long-term capital losses, you could sell it, offset your short-term capital gain. You have to wait 30 days. Like Jeff said, there's a wash sale rule. That does not exist, by the way, for profits. So if you ever want to lock in your profit, you can turn around and buy it right back. But when you have losses, you have to wait to buy it back.
One other suggestion I have is if you are married and your spouse is not working, you might want to consider investing in real estate, rental property, cost segregate the heck out of it.
Can you grab that all for 1 year, even if you put it in service at the end of the year?
Yes. Well, you're talking about your short term, your 15, 7, and 5 year properties, what we call a personal property.
Personal property, you can just grab it.
Those are all going to be subject to bonus depreciation. That's
Everything else is that year end that you get a quarter.
correct. Yeah. So if you put it into effect, say in December, you're going to get very little depreciation on the building itself, but all the improvements in the building and all, and land improvements, you could get a substantial chunk of deduction.
Now, the only thing that I would add is on the charitable side. So this year you have a $300 cash contribution that is it each spouse? I should have looked this up. I was dealing with this yesterday.
Oh, you know what? I'm not sure.
I think it's $300 per return, but
I think so too.
Yeah, somebody just put in, we're actually both around. It's $26,000 that they could put into a 401k. 6,500 is the makeup.
We're still operating in 2019.
Yeah, Jeff, unfortunately, like last week, or 2 weeks ago, that's why Jeff wasn't on. It's just, we were just getting hammered. Our poor guys. It was like, it looked like what's that show?
The Walking Dead?
Yeah, it looked like The Walking Dead. They had blood coming out of their eyes. Their ears were falling off. So the other thing you could do is you could do, here, I'm going to crank up somebody. Maybe you, maybe me. Somebody says our mic's a little low.
Hope that's better.
Yeah. So the other one is giving money away. So if you want to lower your income by 100% this year, you just stroke a check to somebody for, in this case, it'd be $450,000 plus the capital gain. I'm actually being really dead serious on here. You give money away. This would be the year to do it. And here's the thing. Like, let's say that I have the short-term capital gain. It sounds like you've already cashed that in. But if you have assets that you haven't cashed in, rather than make a cash contribution, you may want to give something away that has gain. So the way it works is if I give charity cash, I get to write off up to 100% of my adjusted gross income in 2020. If I give away an appreciated asset, I can write off up to 30% of my adjusted gross income with that portion. So if I want to lower my tax for that $100,000 and I have appreciated stock, I could give that away. I could also give away a house or anything else that's appreciated. If I want to give away cash, I could do that as well. And here's something that I've been looking at. Since we have a lot of low-income projects that we work with, for those of you guys who don't know, Clint and myself have been partners for 22 years plus, and we invest in real estate. We've been really focusing in on the low to moderate income, not like super low income housing, but normal wage Americans, and they got left behind in the last 10 years for housing. There's just a complete lack of it. And that is something that you could set up a housing charity, and it does qualify. Low to moderate income housing, anything that would be considered HUD, as long as 60% or more of your income's coming from that in a charity, you could operate it and you could do real estate. But if I wanted to invest in that real estate, I could take cash this year, contribute it, take an entire 100% deduction. So let's say I said, you know what, I really want to get into the real estate market and I want to put $200,000 in. Normally you'd invest 200 and you'd start to depreciate it. It would offset some of your income. You're not going to get a huge, massive benefit. In this particular situation, I could contribute the 200,000, take an immediate deduction for the 200,000, and then it could contribute it and it could do it. Somebody says, and if you happen to be planning to marry someone who has a capital loss carry forward, can you use their carry forward? You could. Yes. So, Lenore, you get a big star. You must be a tax geek, which means we like you. Somebody says, so I can give 30% of stock and 20% more in cash to charity? Yes. So you could go, well, actually, it's 70% more to cash in 2020. So the way it works right now is your adjusted gross income limitation for charitable giving for 2020 was increased under the CARES Act to have no limitation. So you can offset your entire adjusted gross income with cash gifts. If you use other assets like appreciated capital assets, you have limitations depending on whether it's a regular charity, public charity, or if it's a private foundation. The type of charity I just talked about, a housing charity, or veterans housing, or single moms, like you just fill in your blank, those ones are 30% of your adjusted gross income. So anyway, so you learned way more than about charity, but I mean, those are some of the ideas. Everybody looks. Last things I will tell you, like if you wanted a deduction without doing any of that, you could do a conservation easement. You can get about, for every dollar you put in, you're pretty safe to go to $5. It's 250%. Otherwise, the IRS calls you a listed transaction. You have to disclose it so that they could take a look. But if you're doing a legitimate cost segregation, there's no reason not to do them. So if I invested, let's say that I gave $50,000 to a reputable cost segregation fund that was taking land that they were going to restrict its use in future years, give away its mineral rights, like you want to make sure it's never strip mined or developed. You could give, for that $50,000, you may receive a $250,000 deduction, which in California here, looking at this, this scenario, you're talking about being pretty close to 50% taxation, right? You're looking at for $530,000. So you're not quite the top bracket, but you're knocking on it, depending on whether you're single. If you're single, you're in the top bracket. If you're married, then you're not. But if I did that, then I could take, like, let's just say I took my short-term capital gains and I said, geez, I don't want to pay $200,000 in tax this year. Boy, that stinks. You could give away a piece of it. Do you have any references for cost segregation professionals? Yes. Tyler Surratt and Patty, I hate to do this to you again, but can you somebody says, Toby is saying cost segregation. Oh, did I say cost? Yeah. Conservation, land conservation company. Sorry, Aaron. If I was saying cost segregation, that's sometimes on the back of my head. No, it's somebody says cost segregation. Oh, maybe they are asking about it. So I'm talking about doing a conservation easement, and Tyler Surratt is that company. If you need to do a cost segregation, Eric Oliver is that one. Okay. And I would say, Cost Seg Authority, those guys are pretty good. We have another one down in Texas, too, that are very good, too. But we do have relationships where we can send you over. Greg Ball down in Texas, Eric Oliver in Salt Lake. Both are fantastic. Eric we've been around a little bit longer, but both are good. If you're doing some pretty complicated stuff, then it's just you get to take your pick. More Q&A, lots of questions. Somebody says, do you have any additional information on taxing an LLC as a C Corp? I thought that changing back the tax classification would result in paying extra taxes. So, Carolyn, LLCs are not taxed by the IRS. Mm-hmm. You tell the IRS how you want it taxed. So, Jeff, like, what are your choices on how to tax an LLC generally?
Just about any way you want to tax it. It could be a partnership, S corporation, sole proprietorship. it can't be a trust, but my one question is, can it be a nonprofit?
It can be a trust. Your LLC would never, it can be owned by a nonprofit and disregarded to a nonprofit, but a nonprofit needs to be a corporation.
Okay.
It could be a trust, but why make it crazy? Somebody says, Wash rule. If I sell Apple for a gain, then buy more within a month, then it's okay because it was profit. Correct. Yes, Stacy. So what we oftentimes do is if I have a loss, so if I'm sitting on some loss and I'm coming up to the end of the year, or I am married filing jointly and I'm below $80,000, and let's say that I'm at $60,000, I took my standard, no, I wouldn't take, I took my standard deduction or something, and I'm down there. I now have up to $80,000 of taxable income where I'm still in the 0% long-term capital gains rate. So if I am sitting on gains, I owe it to myself to recognize them right then and just go right back and buy the stock again because it increases my basis. So let's just say I wait a year and I don't do that. And the next year I'm at $80,000 and I sell that. I'm going to pay tax on that at 15%, whereas I could have avoided it. So it gets kind of funky when you have, whenever you're sitting there and you have some gains built in, you all owe it to yourself to really take a look and say, what unrealized gains do I have and what unrealized losses do I have?
Mm-hmm.
And gain, you could sell and buy back 2 seconds later.
Another time this really works out well, and this kind of drives me crazy when I see clients with large capital loss carryovers that they're only getting to take $3,000 a year. Yeah. When they're sitting on a large equity position,
yep.
And you ask them, why don't you sell it? And they say, well, I love this stock. It's okay, sell it. And then in the next keystrokes you make on your, buy it right back. You get to reset your basis to a higher number. And
now they're telling me that you're too loud, Jeff.
I'm always loud.
All right. These guys, you guys are killing me, Smalls. What is the deadline for LLC tax classification for 2021? Well, it's when you actually set it up. It's going to be treated as a sole proprietor if you don't do anything.
Yeah, they're pretty lenient about retroactive. So you could easily go back to January 1st with a retroactive 8832 entity classification.
Mm-hmm. All right, we got to dive in. We love stuff. Our beneficiary IRAs, so you're just regular IRAs, traditional IRAs, became self-directed IRAs to purchase rental properties. We are of retirement age, but don't have to take required minimum distributions yet. Can we convert the self-directed into Roths? Our goal this year is to pay 12% on AGI. That percentage might increase in future years.
Yeah, I mean, there's no limitation on, as far as age is concerned, about converting a traditional IRA into a Roth IRA. The one condition is, and it doesn't apply here, is if you do have an RMD, you have to pay the RMD before you convert the traditional to a Roth. Mm-hmm. So you're paying your taxes and so forth. But otherwise, especially if I'm in a 0 or 12% bracket, and I'm sure my income's going to go up, I may want to go ahead and convert, even if I'm older, which I am. So, yeah, I said it before you could, Joey.
I didn't say it. You're absolutely right. The way I look at it in the numbers is if your tax bracket's going to go up in the future, you might want to convert. If it's going to go down in the future, you don't want to convert.
And here's a mistake that I see a lot of people make. It's not an all or nothing when you do a Roth conversion. You can you can convert any portion of it you want. So you can kind of manage your tax brackets by doing it that way.
Mm-hmm. No, that's absolutely right. So when you sit there and you look at the and you look at what you're doing, so like, for example, in this particular case, I might look at what your tax bracket is and say, all right, what are the chances of it going up or down? If you guys are in a 12% tax, or you're in I guess you'd be in the 12% tax bracket at that point, I would probably say convert your traditionals up to the point where you push into another.
Mm-hmm.
If you think that the percentage that you'd be doing, if you think that the percentage that you have would be going up in the future. So,
Right.
in that way, it's not going to make that much of a difference here. I just don't like seeing people get crushed in taxes. I see people doing that where they're in the 24 plus, and you're like, don't do that. You're going to be paying less when you are older. There's Leticia. Let's see. Lamento que no enseñamos el martes de impuestos en español, which is a really bad way of answering her question. My wife is Colombian and she makes me do some things. Mi español es muy mal. All right. So the neurodiverse living group is something I want to talk about for a second. So some times you guys see me, we'll bring up charities that we like. This is one. This is Jim Richardson out of Pennsylvania. Neurodiverse living, really cool. His son afflicted with autism, and like a lot of parents, they're always concerned about what happens if something happens to mom and dad, and they realize they're not alone. So he gave us some pretty interesting stats. You have over 5 million adults living with on the spectrum. You have about 87% of adults living at home, and more than 80% of adults with autism are either unemployed or underemployed, which makes it really, really tough for the parents, because during your lifetime, you're going to be taking care of them. But what happens if you're not able to? And there's just not enough housing. So these guys have working with the National Autism Foundation. I think it's the foundation. Jim, you have to correct me if I'm wrong if he's on. I don't know if he is or not. He oftentimes pops into our courses, but a really good group. He's probably not. So I'll just say, here's what I'd ask that you guys do. They're doing a silent auction. And if you go to that little link there, you could see the ndl2020.org /silent auction. I don't know if, Patty, you can even do that. Oops, I'm horrible. I don't know how to cut and paste anymore, even out of this. It's the Autism Housing Foundation. There's Jim. Hey, Jim. So, it's one of those things that as a community, we could decide that we're going to make it important. As a investor, you can absolutely profit off of solving a problem where there's a lack of solutions right now. Now, I have experience in this because I rent houses to an organization that actually has autistic adults, and they'll have basically like a house mom. It's actually really cool, and it's great for us because they want 2-year, 3-year, 4-year, 5-year leases is what we generally see. Some of you guys know that I work a lot with Gene Greeno too on residential assisted living. This goes hand in hand, and there's going to be solutions that we have to come up with for these folks, period. Just because it's every parent's nightmare. You're taking care of a child, and your life expectancy is going to be less than theirs, right? In all reality. And the last thing you want is to have a situation where you don't know what's going to happen with your child.
Personal story. My nephew is getting close to age 40, and he is seriously autistic, has some serious issues. And what you just talked about, the where will I live is a huge issue. I know some parents try to keep their adult children at home and take care of them. But these are grown adults with a normal lifespan, and you can't take care of them forever. Eventually, if you take care of them until your deathbeds, they're still going to be left to their own wills afterwards.
Yep, and it's not like they're unable to care for themselves to a certain extent. So in our situation, the houses that we have, it's folks that I think actually I'll steal Jim's. It's like they can do everything for themselves, but they might leave the iron on, and burn down the house if you're not watching. Like there's just certain things that they may not think of as super important. Sounds like a teenager, right? Here's what we all need to do. We need to go buy some One Hope wines from Jim's charity. Anyway, they have a fundraiser, silent auction. It's November 14th. They have a silent auction ahead of time that you can go to. I gave that's the link I gave you guys. There it is, and you can look at it again. And I asked Jim to say, hey, what are some of the cool items that they can buy? And the way it works is you get a donation for the amount that exceeds whatever you buy. So if you buy something that's worth $20 and you bought it for $20, you're not going to get a donation, right? So buy it through your company, use it as a gift. But if you bid something above, like some of these things are really cool. They got Alaska Cruises, Iceland, you got Tango in Argentina, the tropical Key West. Look at that, Ireland. There's a whole bunch of stuff. So and it goes to a good place. So this is the last you guys are going to hear me chirp on it, but do something cool. And yes, you could go there and you can buy wine from Jim. Somebody says Harley Davidson. Yes, you can win a guy named Harley. No, win something cool. But anyway, they do have wine you could drink. That was one of the things that was cracking me up. I was like, if I was going to do charity, that's what I'd be doing, is I would just go buy a bunch of wine. So you can go to a site, check it out, and do some early Christmas. But I'd probably buy like a couple cases. Sherry, you're going to drive me to drink. She's one of her. I'll store it at your house and we'll come on out. Sherry. All right. So lots of questions coming up. I know that's a little off topic, guys, but I tell you what, we got to do something. Government's not doing anything about it. And, I don't care who you vote for. There's portions of society where we're left to our own to take care of these people. Somebody says, Toby, what is the best way to classify a California LLC active business with two owners? One has salary and the one does not. What do you think?
Move to Wyoming.
No. You have an active business, and if you're both working in it. So, Wendy, are you guys both working? Because you really only have two choices. Yes, you're both working in it. So, more than likely, I would make that into an S corp.
I would too.
Yeah, you could do. People do it as partnerships sometimes, and they do what's called a guaranteed payment to partner, but it's clunky, and you don't get all the benefits. If you guys make money in a partnership, you have to pay old age, death, and survivors and Medicare on all that money that you make as profit. If it's an S corp, you don't.
Yeah. One of the issues of having a business in California is that good old $800 LLC fee. Mm-hmm. And it's just the price of doing business in California.
Yeah, it's annoying.
It is annoying.
But you guys live in California. You should be happy where you're doing business because it's so sunny there. Boy, but Irvine got nailed with fires yesterday.
Oh, did they?
Holy smokes. Yeah. Fires have just been crazy this year. All right. I am a high income earner and we have short term rental and service for at the end of this year. There we go. For 12/20 in order to take advantage of tax benefits. So they own something, here's house, and they're putting it into service by the end of the year. So it's going into service in 2020. Would you recommend cost segregation so that we can take some losses? And this is the big word.
Well, let me talk a minute about the short-term rental. Just being a short-term rental does not get it on Schedule C. Mm-hmm. You have to provide substantial services to your short-term tenants. Housekeeping, maid service, a variety of things. So yeah, if you're doing that and can put it on Schedule C, I would certainly do a cost segregation.
So that's called Schedule C, and the question is, and here's the big thing. In order to do that, it has to be what, less than 7 days?
Less than 8 days, I believe. I think it's 7 days or less.
Yeah, it is less than 8 days. Average stay.
Yes.
And
so if you have a 10-day stay, it's not going to blow it for you.
Plus extra services, more like a hotel. Otherwise, this is going to go on your Schedule E, which equals passive, which means your losses will not offset W-2 income.
So this goes back to what we were talking about earlier.
Mhm.
Do you have somebody who can qualify as your real estate professional for this?
You're going to look for two exceptions. You have fours, and they're both going to be in 469C7. You're either going to be an exception to the passive rule where you're a material participant and you're spending more than half of your time, or your spouse is spending half of their time as a real estate professional, development, redevelopment, sale,
Mhm.
construction, any of those things with real estate, not even your own. You're materially participating on your own. Or you're an active participant, which means you manage the manager on your properties, and you get up to 25,000.
Now, if you're a high income earner, that's probably not, you're not going to probably qualify for the $25,000 deduction.
If you make more than 150, you're phased out, but really it's 100,000. It phases out a dollar for every $2.
Correct.
Somebody says, can passive loss offset interest income or dividend? No. So interest income and dividends are considered portfolio income.
Mhm.
So no, it wouldn't, unless it falls underneath the real estate professional exception. So then we just look at that exception, or if it's a hotel or the similar to a hotel. So I think Jeff really nailed it. The cost segregation could still give you a bunch of losses that you can't use to offset your W-2, but you could carry it forward.
And we've seen a couple clients like that where we've done cost segregations knowing they cannot use it in the current year, but they will never ever have income on that property.
Yeah, it's going to be a long time. We've had a few of those. Somebody says, so real estate professional status also phased out on income limits? No, there's no limitation. It's only active participation where it phases out between 100 and 150,000. Somebody said, can the losses offset income in this exact case if my spouse is a real estate professional? Yes, as long as you guys qualify. And then this is the big one. You have to make sure that you treat all of your real estate activities as one activity.
Mhm.
What do they call that, Jeff?
Aggregation of
Do an aggregate.
aggregation of activities.
Yep. So you're saying, hey, all my activities are one. If you don't do that, and many accountants miss it, you're going to be pretty sad if they call you on it. Somebody says, if I move my rental property under my business LLC to generate more write-offs, then will this be an issue? Yeah, don't move your rental property under your business LLC because there's a lot of liability. I will have low income next year because of COVID, but lots of income expenses on my rental property. Pros and cons. Yeah, don't do it because you don't want to bring the liability of a rental property into an active business. Plus, your active business is your active business. If you have write-offs, they're your active business. If it's write-off on your rental, then it's going to be, you could always have your active business manage that rental, but still it's going to be deductible against the rental income.
Yeah.
And if you create a loss, what are you going to do with it?
Yeah, I prefer not to mix real estate activities with active businesses.
Mm-hmm. Now, a lot of our clients will have a company manage their LLCs that hold real estate.
Right.
And that might be something that's worth exploring. So we'd have to look at it. Somebody says, so if you don't have W-2 income, you should not do cost segregation. No, that's not what it's saying. You can do cost segregation. It's just if I'm going to create a loss. So in his particular case, in this case, where they put it in service in December, right at the end of the year, they don't have any chance to make any real income.
Mm-mm.
So in 2020, they're going to have a loss if they cost seg it. If you had put this in place in January and you made a bunch of money, we have clients that make $260,000, $270,000 a year on a short-term rental. Your cost segregation can make that go away.
And when we say a property is in place and service, we mean that it is available to rent. You're advertising to rent it. It doesn't mean that you've actually, somebody's occupying it.
It's
as a
ready
tenant.
to be occupied, which gets kind of weird because they're going to look and see the history on the property, what you did in 2021.
Which is why you always, it's nice to have some kind of advertising going on for that.
If somebody says, can my rental income loss be used to adjust my stock investment income? Would stock investment be treated as capital gains and not allowed? Correctamundo. So passive losses offset. So here we go. So capital loss offset capital gains plus $3,000 a year of other income. Passive losses offset passive gains. Period. There's nothing else that it's going to offset. They don't offset each other. And then you have ordinary losses, ordinary income versus ordinary losses. And ordinary losses offset everything.
Right.
You can use ordinary losses for anything. So if you have active loss, ordinary loss. So there, you guys are all CPAs now.
See how easy it is?
Mm-hmm. When you write it out, it's not that hard. I always have to use a little, like, all right, what type of income is this? Or is it following underneath one of the exceptions? Oh, goodness. Yeah, so is stock short-term gains a passive income or short-term capital gains? Oh, look at you guys. All right, so we'll go back to this. Short-term capital gains is capital gains that's taxed at your ordinary rate. So it's not ordinary income. It's not active income. It's technically it's portfolio income.
Right.
It is not passive. Passive, there's only two types. Passive is real estate and businesses in which you do not materially participate. So I own a piece of Uncle Lou's pizza shop, but I don't do anything. So I'm not doing anything. I'm just a passive investor. So passive loss cannot be adjusted against the stock investment income. Exactly. Unless you're a real estate professional, in which case your passive losses. See, isn't this fun? If you're a real estate professional, then that's an exception. And then your passive losses, if you're real estate pro, so let's just say your passive loss becomes ordinary if you're a real estate pro. And then it can be used against everything. So it's so much fun. Somebody says, talk about passive loss limitations. We are. You can't use them. There's none. You can't use it against anything else. I lose money in real estate. I am stuck. I don't get to use it. I get to carry it forward until I sell that real estate. And if I sell the real estate, then I get to make it as an ordinary loss when I dispose of the asset.
Correct.
Otherwise, I just carry that forward and wait for passive income.
Yeah, it remains passive and a passive loss until you dispose of that activity.
Yep. All right. I have a residential. There's so many questions coming in. These are fun. All right. I have a residential property that I will lose next year. So it sounds like, somebody's just getting tased, tax liens.
Mm-hmm.
Can I write it off this year instead of minimize my owed taxes? The property is a small lot that I bought for $65,000 cash 15 years ago. The property is encumbered by property tax liens and lot cleaning liens. So they never had any depreciation if it's a lot.
Right.
It's just land. And you're going to have it taken away from you, which means it's being sold.
Mm-hmm.
So they would have a little bit of, would they even qualify for the loss?
Yeah, they would qualify for the $65,000.
As long as it's not your personal, like if this is part of your house and you're living on it and it's like your backyard, then no. If it's personal, then it'll be personal property.
Yes.
But if it's something that was an investment property that's sitting there, you never got any depreciation, you would get the loss when you dispose of it.
Correct. If the problem here is, well, there's two problems. First, to answer your question, no, you cannot take the loss until you no longer own the property.
Correctamundo.
The second problem is this is going to be a capital loss, and I believe we've talked about those in the past.
Capital losses means you have restrictions on how much you can use. Because this wasn't a investment that is being disposed of.
Right.
So unless you lease this thing, the other funky one is, I wonder who's responsible for those tax liens and lot cleaning liens.
I'm assuming they're going to be wiped out when they do the sheriff's auction.
Mm-hmm.
But I can't say for sure.
Would there be a tax implication if you don't have to pay back the lien? I mean, the lien would say there's a debt. If you sell the property and the debt goes away, I'm just wondering whether they're going to get any
I have not seen that. I haven't seen where any of the county agencies have called that forgiven debt or.
Mm-hmm. Here's a good one. I'm going to jump because I see good questions. All right. My husband is a real estate professional. He has excess ordinary loss from cost segregation. Can that loss be carried forward to future tax periods? So now we're going to say net operating loss, which is what you're going to focus into. So it's ordinary loss.
Mhm.
A real estate professional equals NOL when you have losses. And in 2018, 2019, and 2020, you can carry back 5 years. So Helen, you can carry those back and get monies back. If it's this year, you can go back to 2015 and get some of the taxes you paid then, carry it forward to 2016, 2017, 2018, 2019. And you can carry it forward. Isn't it indefinite?
Indefinitely now.
That's why we like that question, because it's a good answer. So Helen, you're a rock star. Yeah, somebody just said, what? Yeah, so when you have net operating losses, this is where it really comes into play. If you are somebody who qualifies as a real estate professional and you create losses because you cost segregated a property, and we've done this how many times, Jeff? Like hundreds of times.
Yeah.
If we create a loss, then you can go back and get some of the taxes that you paid in the past. And your example is somebody named President Trump. The whole issue with President Trump was when they took real estate depreciation and accelerated it, and it created a $96 million loss or something. And he'd been carrying it forward. So he keeps saying, well, I prepaid my taxes. No, you had lots of loss you couldn't use. You were carrying it forward. And during the Great Recession, they unlocked it and did the same thing where they said, hey, you can have a 5-year carryback. And so he just elected to say, oh, I have all these things that I'm carrying forward. I am going to carry them back. Now, if you want to carry back, there's two ways you can do it, right?
Mm-hmm.
You could either amend those past returns. So somebody's asking, how do I carry back? How do you elect to carry back? If it's the year of return, like if we did it for 2018, do you follow form?
For 2018, if you want to carry it back, you have to go back and amend those years starting in 2013, 2014, 2015, so forth.
So you would amend your whatever years you're going to use up
Right.
the loss. So let's say I had $100,000 of loss and I had $100,000 of income in 2013. You'd go back to 2013 and amend that return and make it zero.
Yep.
And any taxes you paid that year, you would get back as a refund.
Now for 2019, if you have an NOL carryback, you have until December 31st to file it on it's Form 1045 for or individuals and 1139 for corporations. This is a quick refund form, and we've seen pretty quick turnaround for refunds with these.
Mm-hmm.
2020 will work the same way. You'll have till the end of 2021 to file those quick refunds. Now, if you go past December 31st of 2020, you'll have to do the same thing you do for 2018 is go back and amend those prior years.
Yeah. So you could do it a little bit easier this last year and this year, this year and then this current year. So 2019, 20, you have a little bit of time on 2019.
Yes.
2020, you have until this time next year, or a little bit longer than that. So you have 14.
Now, one thing you want to make sure you do before you just blatantly carry these things back or forward or whatever,
Run the numbers.
run the numbers. Because if you were in $50,000 of taxable income for the past 5 years, but you're going to be in $500,000 of income for the next year,
Yeah.
you want to carry that sucker forward.
And you might want to pay attention to who gets in as president. Because if brackets go up, this is your get out of jail card free if you're making a lot of money. Somebody says, I am fine now. Can I ask a question? You can always ask a question. Do you have to have been a real estate professional in those past 5 years? Jasmine, no. So it matters in the year that you create the loss. So for example, if I create a net operating loss because I become a real estate professional in 2020, then I go back to 2015, 2016, 17, pretend that's a 17. Gosh, somebody should take my pen away from me. 2017, 16, 18, and 19. And I'm going to use those losses against all those years. And if I still have losses, then I'm going to carry them forward. So you have ordinary loss. So ordinary loss works against all other incomes. So we can go back and anything that you made in the past, we can wipe out. We can use it. Somebody's asking some funky questions. Do I need to have made the real estate purchase by close of 12/31/2020? If you're going to create the loss, this is the last year you can carry back loss. So you'll have to close on it in order to do the cost seg for sure.
And
it has to be in service.
And it has to be in service.
Yeah. So you can't just close. You actually have to have it ready to be occupied. We already answered carrying it back. What about becoming a real estate pro? Wouldn't that allow me to use it? No. So real estate professional is just for that particular year as to whether the loss is passive or ordinary. If you have carry forward losses, they're always passive. They remain passive. So somebody says, when is the 5-year form supposed to come out?
There is no 5-year form.
It's already there. Like you're making the election. Yeah, so don't worry about that. Sounds like I should wait. It helps. There is another syndication that was considering, but with an answer like this, it sounds like to me I should wait. Yeah, it's always math. I always say that there's 3 rules in tax and anything financial, which is calculate. Those are your 3 rules in order. So you always go back and you make sure that you sharpen up your pencil. How do I qualify as a real estate professional with a full-time job? You don't, unless you spend more time as a real estate professional than your full-time job, which would be almost physically impossible. I suppose you could do it. If you spent 2,001 hours on real estate activities and 2,000 hours in your full-time job, you would qualify. But
in those cases, the courts are turning them down left and right.
they don't believe you.
Basically.
Yeah, so you better not work so much. And sometimes you look at it. We actually had a client, it was 2 doctors. They made more money having one of them work part-time and qualify as a real estate professional because their taxes went down enough and they were able to use their losses. And as a result, they ended up receiving a lot more money because every dollar they were making was being hammered at close to 50%. So it just didn't make sense.
And hopefully your real estate's also appreciating at the same time.
Yep. Can you carry back loss even if you have a PPP loan? Yeah, doesn't matter. PPP loans are great, but they're based on your payroll. We don't really care about the well-being of the business, which, by the way, is a pet peeve for me. It really bothers me that so many of the news were hammering people for taking PPP loans. The reason that they gave the PPP loan was so you wouldn't lay your people off. Had nothing to do with your financial viability. Had everything to do with please don't put them on employment, or please don't put them on unemployment where we have to care for them through the states. The federal government said we'll step in and we'll pay the employer to keep them on their payroll. It had nothing to do with whether you need it or not. That was stupid. And then they come back and they they start making you certify, well, I actually need this. It's like, that wasn't what Congress did. Congress said, hey, please don't lay your people off
Right.
in the middle of a pandemic. We'll pay you so you can keep them. Ridiculous. They're going to punish you for taking advantage of the very laws they pass to benefit you. What are your thoughts about tax incentives given Act 20 and 22 in Puerto Rico? The caveat I understand is that you must be a bona fide resident of Puerto Rico in order to get a tax incentive. It almost sounds too good to be true. Can the U.S. federal government stop this at any time? You feel like knocking on the
Well, I'll start with the very last sentence that their question that there is actually a law in place that exempts residents of Puerto Rico from federal taxation. As far as Act 20 and 22, those are the two big ones, but there's a number of other Puerto Rican acts that also give incentives.
Yeah, so the easiest way to look at it is if you're a United States citizen and you live in the continental United States or in other territories, certain non-exempt territories, everything you make in the world is taxable. If you're a U.S. citizen and you make money anywhere in the world, it's taxable. But if you are a resident of the Commonwealth, I think it's the Commonwealth of Puerto Rico, and it's a territory, then you are not subject to federal taxes unless you are making that money from the United States or you work for the federal government. Like, there's a few little exceptions.
Yeah, so Act 20 is an incentive for companies to move to Puerto Rico. Act 22 is the individual incentive, and I believe it only exempts what they want is investors, and it only exempts interest, dividends, and capital gains.
Yeah, so there's never I don't think there's ever a federal income tax on when you're working there yourself. I think that you get the federal income tax on other things that are derived elsewhere, and this exempts them so long as it's a qualified Puerto Rico company. I believe that you have to have a Puerto Rican employee at a minimum. And if you're and to be a bona fide resident, you have to be there physically on that island at least 1 minute for 183 days of the year. And you can't have another residence elsewhere. So they have to know that you're living there. And we've had several clients move there because then you're at a 4% flat tax and you have zero tax on your capital gains and on your interest income and I believe on your dividends. So you really do. I've seen the numbers run, and like, let's say somebody's making $500,000 in Puerto Rico, you'd pay a little bit over. You'd pay right around $20,000 in tax. That same individual making money in Maryland would pay $226,000 in tax. Those are the numbers I remember looking at it, going, "Wow, you literally lower your tax bill 90% if you decided to live there." Just spent a month there. Sandra and I went down there. Went to where did we go? Rio Grande. They have Carolina. They have great areas. If you've ever been down to Puerto Rico, I'd encourage you to visit. There's Carolina. There's Hobo Beach around there. You have San Juan, downtown San Juan, which is just gorgeous. You have the big fort, and you're looking out over the water. Absolutely gorgeous. Hey, if you like tax stuff, we just came out with the tax toolbox a couple months ago. Actually, maybe a month ago.
Yeah.
Was it a month ago? It's all blending. Somebody says, we are moving to Puerto Rico. Love Rio Grande. Yeah, absolutely. There's some gorgeous areas, especially if Biden gets elected. He'll still find you, Sherry. All right, so the tax toolbox, we go over all different types of income. There's about 20 different videos and about a 300-page manual. You can go there. It's $595 if you want the physical version, $495 if you just want the e-version. But here's the real cool part. That's not, the link isn't the cool part. The cool part is you get to come to TaxWise on December 1st. And we're going to go over about 32 specific tax strategies, and we will know who's president and we'll be able to do some evasive action. Hopefully it'll be straightforward. We'll know what to do, but there are definitely some things you're going to want to do depending on who gets control of the House and the Senate, because there's some promises that are people making, and we do have things that are going to phase out and sunset. So we're looking at a minimum 2025.
Right.
And depending on who gets in, you could bet your bottom dollar that some of those things are going to go away. And it's just a matter of putting yourself in a position to take advantage of whatever the laws are at that particular time. So there's your little link. If I don't know if Patty can share it out. We always share this stuff out, but go to the Tax Toolbox, over 20 videos and a cool workbook, and then come to the TaxWise workshop for a day on December 1st. If you do not put $10,000 in your pocket from some of the strategies we hit, I don't put guarantees on things, but I'll give you your money back. I'm just not worried about it. You're going to find stuff. We're good. All right. Question and answer. More stuff. Somebody was asking, can a pilot flying 600 to 700 hours a year qualify as a real estate professional if he self-manages 2 to 3 properties and also runs short-term rentals, takes classes, education, masterminds in excess of 750 hours, high risk? No, it's not high risk. And yeah, you would qualify under all those examples. Just remember, here's how it works. If you are single, then you have to, somebody says, I got $36,000 from the CARES Act webinar. You guys rock. Thank you, Wendy. We put money in pockets. So I always tell people, if you're not getting at least 3 or 4 times whatever it costs to work with us, then we're not doing our jobs right. We're supposed to be the guys that you like to talk to, because every time you talk to us, you make more money. So we're kind of like guys. We have all the numbers that you put on the lottery tickets. That's what we are. Look at some people are actually being nice to us. Usually they just heckle me, but now
I know.
this is like maybe they're feeling bad for us, Jeff. Maybe they're feeling bad for you because you have to sit next to me for all this time. So yes, Evan, as a pilot, you'd be able to qualify so long as you materially participate with your properties. And what that really means is, are you able to spend 500 hours on your properties and on the management? They don't count the education and some of the mastermind on that 500 hours. They want to know what you're doing on those properties. Right. Is there anything I'm missing on it?
No, your hours are going to be counted for what actual work you're doing, either on the properties or with the properties. And then we're talking about books, renting out the properties, just the general management of the properties.
Mm-hmm. So, and remember, you could, if you're self-managing your properties, you don't have any hour requirements. You automatically are materially participating. The only ones that I'm worried about is those short-term rentals. And I doubt anybody's spending more than 100 hours on it. So you just want to make sure you're doing 100 hours, aggregate all your properties together. The short-term rentals worry me a little bit. As long as they're 8 days or greater, then it's passive. So I want to make sure that we keep you passive. I don't want you to become a hotel. There's a workaround if you do become a hotel. What we do is, somebody says they feel bad for Patty. Patty's not the one who has to sit next to me, Mark. It's Jeff. Patty, she moved downstairs. She's hiding. I can still hear her sometimes cackling from up here. I'm on a different floor and I can still hear that Patty sometimes. Man, it's crazy. The whole building shakes. Just teasing. Anyway, I forget what we were talking about, but I'm sure it was good. All right, let's go. How can I take a deduction on my taxes for working from home? I use a portion of my bedroom to work online. I had to upgrade my computer and internet speed.
If you are working for an employer that is not you, I have bad news. There's really no place to take deductions anymore.
Yep, you have no unreimbursed deductions. Unless you're a teacher and you're buying crayons and stuff. I think then you get up to $250.
The 250.
Yeah. So this is sad if you work for a third party.
Now that third party can reimburse you, and those reimbursements are tax free to you.
Mm-hmm. They can reimburse tax free. You don't have to report it. So we make a smiley face there. But now if it's you, so you're a sole proprietor,
Mm-hmm.
then you could do what's called a home office deduction.
Yep.
There's a special form for that. or if you're an S Corp or an LLC taxed as an S Corp, or a C Corp, or a LLC taxed as a C Corp, or a nonprofit, and you're an employee of that, then it's the same rule here. They can reimburse you tax-free. Now, here's the big difference. That sole proprietor, that home office deduction might be $5 per square foot is the safe harbor. So if you have a portion of a bedroom that is exclusive use and it's 50 feet, you're going to get a $250 deduction per year. It's nothing. Where it really comes into play, where the benefit is under these guys when you're an employee. Somebody says possible audit. Yeah, there is the adage that having taken the home office deduction, but the only party that takes the home office deduction is the sole proprietor. And it really doesn't matter whether you take the home office deduction. If you're a sole proprietor, you're probably going to get audited.
And if you're doing the safe harbor for the home deduction for the $5 per square foot, unless you're taking a ridiculous amount of square footage, they're not going to audit you.
Yep.
For that.
Yeah. So I'll show you how to do it. The screen's going to go black, and I mean to do that. So here's your house, and usually you're doing the total square footage. So let's say that your apartment, I don't even know what a good apartment. What would it be?
1,000 square feet.
1,000. So we have 100 by 100. And you have this little room that is work only. Is that right?
100 by 100, no. That's a 10,000 square foot apartment.
Oh, really? 10 by 100. Okay. So it's a big long house. I don't know. What would be another one? 50 by 20? Yeah, whatever. Here. By 20. All right. So we have 1,000 square feet. So we have 1,000 square feet. When you're doing a home office as a sole proprietor, it kind of stinkolas, right? They're going to let you use that square footage. So if this is 50 feet compared to 1,000 square feet is what is it going to be? 1/20th?
Mm-hmm.
So you're going to get what, 5%?
Yep.
5% tops. Now, if you do a employee reimbursement, it's going to be closer to 20%, and here's why. You can still have your same area, but what they allow you to do is use your net usable square feet. So you're going to remove all the hallways, you're going to remove common areas that don't really have much use, and you're going to knock that 1,000 feet down to closer to 700 or thereabouts. And so now you're going to have a much larger percentage. Now you're already getting up there to what would that be? So around 7-8%, right? Even if you still have that tiny little area, you can get more aggressive with it. Or you use the room method. And the room method is probably the best. And what you do is you say, how many rooms do I have? And how much? So let's say that this is a 2-bedroom small area, maybe take a total of 3, and you're using half of a room or 3/4 of a room. So you're going to basically say, hey, I'm using 3/4 of a small room in a 3-bedroom house or a 3-room house, where again, you have 2 bedrooms and a common area. They might call it 3 bedrooms or 3 areas, and you're using 3/4 of one of them. So you would say total areas you have is a total of 3. So I don't know what that adds up to, but it's something of a much greater percentage. Somebody would have to tell me. It's not quite 1/3. It's probably closer to 20-something%. So 0.75 goes into 3. How many times? I don't know.
9/4.
I should actually do the math. I think it's huge. I always get these backwards. Whenever I'm playing around with numbers, I always have to double and triple check myself, because God knows I just start typing things in. Divided by 0.35. Yeah, it's about 4. So let's say 0.75 over 3. 25 Yeah, about 25%, somewhere around there. So we're going to be 20% plus, and we get what are called direct expenses. And this is a big one. When you do your 20%, it's going to be 20% of all expenses. So let's go back to this. Remember our 20%. Oops. Our 20% means that we're going to get all 20% of all expenses associated with that apartment, which means my electricity, cleaning, internet, etc. If I have rent, then it'll be rent. If it's my mortgage, it would be my mortgage.
Mortgage interest.
The mortgage interest, plus I would get a percentage of depreciation. And this is somebody just says, is this how the administrative office is calculated too? Yes, this is an administrative office for the home. And yes, your business can have a primary place of business and an administrative office. So if you're wondering whether you have a work outside of it, so you have an office and then you have a home office, yes, you can even deduct the mileage between those two. But the big one is you had to upgrade my computer. That's 100% deductible, that upgrade, and reimbursable, and internet speed. I can now deduct that extra cost at 100% too. Those are called direct expenses.
Mm-hmm.
So as a result, I go from this measly little 250 to hopefully a big chunk of money, 2,500 plus. Like you should get 10 times the expense, is what we see. Is that about right?
Mm-hmm.
Okay. So, and it's not reported anywhere. So you're not filing a special form that says, audit the hell out of me.
Yeah. So when you're reimbursed by a company, the company is taking the expense, but you're not recognizing any income on that expense.
Yep. We like it.
I like it.
We like it. So that's one of the reasons why we tend to push people towards structuring themselves as a business, because they tend to be treated much better. Can my daughter do this in her dorm room with the desk area versus her half of the room against the cost of the dorm? If you have a business and she's using it exclusively, so this is a big one, exclusively for business. So yes, you can use a partial room as long as you take pictures and say, this is my area. This is the area that I am running my business out of. And yes, they can be running it at your business too. So a lot of folks that we work with have their home or their family business. They'll have their family corporation. That's the management entity. And I'll say, get your kids involved. A lot of times you'll have nonprofits and they'll put them on the board and make them officers or have them act. But yes, you could absolutely do this. And somebody says, should reimbursement be paid to an employee via salary or separately? Well, Wendy, it's not salary because it's not taxable. It is separately, and all it shows up as an expense to the business, whatever that business is. You do not have to report that to yourself at all. You don't report it anywhere. So the example I give is if Patty's on the way to the office and I say, Patty, hit Pig Box and bring in some donuts, and I'll reimburse you when you get here. Or quite often we do pizzas and stuff, or sometimes at the events, you guys know this, if you've been to the live events, sometimes we bring in lunch or whatever, and I'll say, Patty, go out and grab something, and she'll go out and she'll throw it on her personal credit card. And she just comes back in and we'll just pay for it. Here, Patty, here's some dollars, or write her a check. She doesn't have to report that anywhere. Same thing as if your employer said, hey, on your way into the office, could you pick up some office supplies? And you grab it and you bring it in and then you do it. Somebody says, I asked because my payroll gave me the option to pay reimbursements. You can. Usually reimbursement plans, they're doing that because they want to make sure that you're doing it timely. Usually within 90 days is good.
So we actually do that at Anderson now. Like we sometimes pay directly, but we also run our reimbursable expenses through payroll.
Mm-hmm.
And it's not has nothing to do with taxable income. It's just additional money you're getting in your paycheck.
Yep. And if you like this, by the way, we do the breakdown and we give you all that stuff in the toolbox. Toolbox. That's my gentle pushing. If you like this sort of stuff, we do this during TaxWise, and you have all the documents, and it goes over all the rules as well as an accountable plan, which we put in writing. We do all that fun stuff. It's always fun to put it. So Patty, where are the donuts? So that's all I want to know. Where are them donuts? All right. If we are part of several syndications, can we deduct requirements to be a partner of the syndication and other expenses for being part of the syndications? So they're basically saying, hey, I'm in the syndication, but I have to be a member of a bunch of groups. I'm probably going places where, we have to spend a bunch of money. What say you, Jeff?
In 2017, the answer would have been yes, you could deduct that. In 2018, the answer is likely no.
No, unless. Right?
Mm-hmm.
No, unless. Usually what you're doing here is you're going to want to have a corporation or something in the mix. And so you're going to have, here, I'm going to go black for just a second. So let's say that I have a syndication. And so they offer me a piece. And I have, let's say, 10%. And I might place that in my LLC. And that LLC may be partially owned by a corporation. This means that this LLC is considered a partnership. If you're wondering why I wrote 1065, it's because that is that's the tax form for it. So just a minute. Somebody says, Patricia, I can hear you. I hope it's not me you're referring to, so we're all muted. That's pretty funny. Now, see, somebody wants some Krispy Kremes too. There's a bunch of them. Anyway, so what it means is this guy can be a guaranteed payment to partner. And plus they get a little interest. So maybe you're getting 10% of your syndication going in here, and that corporation's entitled to 1% of it. 99% or, whatever the amount is goes down to you. So you're sitting there going, hey, this is a way that you could carve off some of it going up there. And then this is the corporation where you cover all your management. This is where you could do all the reimbursements, for all your classes, all that stuff. That's the way to do it, is to don't tempt fate. If you were a manager of the syndication, so if we go back to here and you're a manager, so you're not just a partner, but you're actually a somebody who's running it, chances are you're going to be doing that out of an active business anyway, because you're either the manager or the general partner.
Mm-hmm.
Mm-hmm. All right. Keep jumping on. I know that we're late. How do we go over? Seems like just started. What is the difference between short-term and long-term capital gains? And the difference between owning the property in a personal name or LLC with regard to capital gains? Is it always going to be like ordinary income? So, Jeff?
Starting with basics, short-term capital gain is a gain on any asset that you held for less than 12 months or a year. Which way are you going?
Less than 12 months, or less than a year. Say less than 1 year.
Long-term capital gains are more than a year or more.
And this one's equal to your ordinary income.
Correct. Back years ago, they established a law that said long-term capital gains could be taxed at a lower rate to encourage investment. And that amount has been all over the place, what those percentages are. So long-term capital gains, short-term capital gains, they're taxed at different rates for selling investment assets.
Mm-hmm. And you can have this even if you held it longer than 1 year if you are a dealer, if you have inventory. Right. So if I have, it's not really short-term capital gains at that point, it's just ordinary income.
Right.
So you got to be a little careful of that. But as far as how it relates to the LLC, it doesn't. Remember, the LLC doesn't exist to the IRS. So the IRS requires you to tell them what it is. And the only entity where we have to be careful about those capital gains is a C Corp.
Correct.
Everything else is going to end up on your return anyway.
So there's a couple of provisions we've talked about, the taking $3,000 of losses a year and the special rates that Toby wrote at the bottom of the screen. Those only apply to individuals. You cannot take capital losses in a corporation, and capital gains are taxed at 21%.
Capital gains, because they're all income in corporation. It's just a C corp. Or if it's an exempt, it's not going to have any taxable gain.
And I've seen those capital gains your capital losses get stuck in these corporations, and they're hard to recover from.
Yeah, we don't like it. Plus, if you have a capital asset that appreciates in a corp and you take it out, like real estate, to refinance it, it's taxable to you as though you paid yourself salary.
Yes, it is.
It's vicious. So don't do it. That's why we don't put real estate in corporations for the most part. There are a few exceptions, but for the most part, don't do it. Is there a time limit on reimbursements? I started at the end of 2019, but did not do any reimbursements. Could I amend to do them now? The money actually has to be paid to you.
Yeah, most of those restrictions are self-imposed by companies, mainly to keep employees from coming back a year later and say, oh, I forgot to turn this expense reimbursement in.
The IRS does say timely and that you're supposed to have some sort of agreement.
Right.
So we put together in all of our companies, there's it's called an accountable plan. It's what its technical term is, but it says basically that you submit and then the company reimburses you. If the company has no money, then it says that. So it says 21% is great, but in order to get it out, you're going to pay a dividend rate to get it out, or it's going to sit in the corp. And then they said, wait until Biden plan comes in. He's going to knock that up to 28%. Still way lower than it was. Nobody can really argue that it was smart to have a 39 top rate in a C corp. It went up to 39, and then at the end went to 35. But everybody said that 35 was the high tax. And I'm like, no, actually the high tax was 39%. There was a good chunk of it, 300 grand that you're getting 39%, which is crazy. That's why a lot of companies didn't want to be here, go someplace else. Somebody says, does the employee have to submit bills? You should have some backup. Technically, you don't have to, but you should.
Well, under audit, they're going to be required to substantiate the reimbursements under the accountable plan.
Yep.
And the problem is if you're not able to substantiate.
But if I have the check that I wrote and I don't have the bill, that doesn't mean you can't reimburse yourself. It just means you better have access to the bill, right?
Yeah. And actually, it's the company's responsibility to have the bill. Yeah. Not the individuals. Because the problem is if they can't substantiate, it's no longer an accountable plan.
Yep. And what's fun is in our companies, especially all the reimbursement plans, it says if you ever have a disallowed reimbursement, we just treat it as a loan to you. So you don't have to worry about a taxable event to you. The company would be like, hey, we loaned you that money. Wendy, you're going to have to pay it back now. So, but have you ever seen that where we've not had the backup on it? Not here. We're going to find it. So, I didn't mean to contradict Jeff. I'm just saying is that if you know what the bill was, if you're paying it on a credit card all the time and you know what you paid, reimburse yourself. But know that if you get audited, you're going to have to produce the actual bill. You're going to have to go get a copy of it.
And I'm often guilty, as I'm sure a lot of single employee companies are. I spent this much on it, and I'm just reimbursing myself. And you'll dig up that bill if you need to.
Raise your hand if you do that. Everybody just raised their hand. That's just a life of being in business. And I say this all the time. It's like, make sure that you're not tripping over pennies on the way to dollars.
Right.
Yes, you can do, like, the IRS can't even tell you what books are. And I always remind people, we were using abacuses when most of this code was written, right? I still remember doing double entry with a pencil in a journal book that we'd go by at the office store, and we would keep our books in pencil writing. I mean, Jeff, they were probably using sheepskin and rocks in your day.
Yes. If you ran out of papyrus, you used whatever you had.
That's horrible. I know somebody, see, you guys are just not much fun out there. And it doubled his toilet paper. What are the warnings, limitations of investing in real estate through a SIDRA or a solo 401k, self-directed IRA or 401k, especially when the deal is leveraged? So here's the easy way to look at this. Self-directed IRA equals custodian. So you're always going to have somebody else acting on your behalf. Somebody says counting in skulls. You guys are horrible. IRA also means unrelated debt financed income, which equals loans, which equals tax. The portion of the income that's derived from a loan is taxable to an IRA. It also equals one person. So if you're a husband and wife and you're buying things together, it means you're going to have to combine your IRAs as co-tenants, or you're going to have to set up an LLC that they both own in order to have a single account. 401k does not have UDFI. It does not have unrelated debt finance income. It can be multi-people and no custodians if you don't want it. The ones we do here at Anderson have no custodian. You are the trustee. So in any of those situations, you're going to be fine. Like, it's not going to blow up your deal, but you might have some tax if it's UDFI, which kind of stinks. So if you're making $10,000 a year and half of the property is financed, then you would have $5,000 a year of income in theory. You try to offset it with things like depreciation. There'd be a portion of that you'd be able to use for depreciation, but you could be looking at a taxable event inside that IRA. If you sell it, then a portion of the gain, even though it's an IRA, a portion of that gain would be taxable because you use leverage to get it. You don't have to worry about that in a 401k. So you're always going to see us saying, do a 401k. You can put more money into them. A husband and wife could have one 401k, whereas you'd have to have two IRAs, all that good stuff. All right. I don't even know how close we are getting done. Oh, we have two more questions. So let's jump in. I just won't miss it. You stated not to place real estate in an LLC. If so, should you place? No, I didn't say that. You always put real estate in an LLC. You don't put it in a corporation. So an LLC taxes a corp. Do you need to be self-employed to have a solo 401k? You need a sponsoring entity. So it could be an LLC, a C Corp, an S Corp. You could even have an investment LLC sponsoring a 401k, and no, you don't have to put money into it. You don't technically have to be taking a salary. You could fund a 401k. Like, let's say I had an IRA, I could technically roll that into a 401k as being the only money that goes in there. So I can just roll an existing amount. So let's say I have $200,000 sitting in my IRA. I could just roll it, and that would be my only funding, and put $200,000 into a 401k. So I can do that. How would you combine a husband and wife funds in a solo 401k to make one investment? There are 4 bank accounts, 2 Roth, 2 pre-tax. So the Roths you can't roll anywhere. So the rule is a Roth IRA can only go to a Roth IRA. A Roth 401k can go to a Roth IRA, but not the other way around. But you can combine your 2 pre-tax accounts into a single 401k. Somebody says, if I maxed out my solo 401k, aside from leaving any residual to my C Corp, where else can I put my funds? Well, if you maxed out a 401k, what else would we look at as far as retirement plans? I'd probably be doing a DB plan, Janet. If you are maxing that out and you're making that type of income, I'm looking at a defined benefit plan at that point. And I want to be able to put a larger amount without worrying based on your income. And usually, depending on how old you are, it's usually going to be 70 to 150,000. We do have clients where they're able to put their high income earners and they're older, where they're able to put 600,000 plus into the defined benefit plan per year, tax deferred, something like that. What is the turnaround for 10, 11, 20s now that the tax deadline is passed? How long does it take to do a corporate return?
I think we've been quoting turnaround times of 6 to 8 weeks because we still have a number of returns we have to do. We have September and March year ends coming up in January, so we'll start working on that.
Okay.
We'll go a little faster once I've revived all of our tax preparers.
Yeah, they're still looking a little hairy. But they're coming around. They always do well after Halloween because they eat all that candy. All right, so Janet, if let's assume somebody is 56 and they put money into a DB plan. The way that they calculate the numbers is they look at your current income for the last 3 years and they come up with X. And they come up with X dollars. And they figure that before you retire, you might have 9 years. And in order to have X income of benefit, you have an actuary who plugs all the numbers in and says, we need to have, let's say we need to have 2.5 million sitting in this thing in order to kick you whatever your current income is. It's up to 220,000. So the numbers get big quick. So in order for it to pay out benefits until you're past, so if it starts kicking it out when you're age 65, and it says, hey, I need to be able to do that for 20 years, there needs to be a sizable amount in there. So let's say it's 2.5, then it's not dividing it by 9 because you have to factor in things like, what is it called? I'm blanking. Cost of living increases, inflation. Yeah, so you have your inflation rates and things like that. And the growth on the investment. So you factor those in, but it's essentially like that. So you might be able to put under this scenario about $250,000 a year into it that you'd be able to do first. So your scenario, you're going to be a huge amount. So if you don't want to pay taxes for a while, Janet, you could actually, we would be happy to put you in touch. Eric Dodds is who I'd send you to right now. Let him run and crunch those numbers. If not Eric, then probably David McShane. Both those guys are really good. And somebody would look at it and tell you based off of all your employees, how much you'd have to give for employee benefits. If you don't have employees, then how much you'd be able to do. And it really depends on that you're making this money through your business. So hopefully it's your business. What is DB, defined benefit plan? So there's two ways people calculate the, let me change this again. So there's defined contribution. For example, if you have a 401k, I can put in employer side, I can defer 19,500, and then the company can go up to an additional amount up to 57,000. So they're defining what the contribution is. And then there's defined benefit. Defined benefit, where I am saying I want to receive, $150,000 a year when I retire. So you can kind of see how they're different. I'm looking to say, I'm reverse engineering it when I'm doing the defined benefit. And by the way, there's more money in defined benefit plans in the US than there are in defined contribution from what I've seen. In other words, we're able to put such huge amounts in because the amount that you're able to receive as a benefit is up to, this can be up to 220 plus. I forget what the number is for this year. It's right around there, which means that if I have 20 years where I'm going to be receiving over $200,000 a year, just kind of do the math in your head. I'm going to have in some cases more than 10, $15 million in there.
Yeah, when you think about all the old retirement plans before the existence of the 401k, the old GM plans, and those were all defined benefit plans. It was a company putting in all the money, not the employees.
Mm-hmm. Yeah, they're potent.
They are potent.
Yeah, so Janet, I would take a look at it. Somebody says, so I have to be a real estate professional to be able to carry back the loss. Where did that come from? That was like from way before. Jasmine's on a leg, so we're going to make fun of her. Yes, you have to be a real estate professional to carry back the loss on real estate losses. On other ordinary losses, like if your business loses money, you're sole proprietor, you have a bunch of losses, or you have net operating losses out of an S corp that you have basis for, you'd be able to carry that back. That type of thing, then you can carry those back 5 years as well. All right, I'm sitting on about $250,000 of equity in a rental property that is paid in full. So that means that it's worth about $250,000.
Mm-hmm.
So what are my options to get the money out and into an active investment such as LP? So an LP is not, that's passive. I'm going to make fun. They say active, so I just say another in another investment such as an LP in a syndication or something on lock. You can just take it out, right? Borrow the money.
Mm-hmm.
That's all I would do is pull the equity out. You can always pull the equity out without tax implications. The only time you have an issue is when you have a negative capital account, which means you have no basis, you're not on the hook. The best example I can give you is if you do, let's say that you're a passive investor in a syndication, and let's say you put in 500,000, and the total investment was 2 million, and you levered it up to 10 million. It did a bunch of repairs to an apartment building. Let's say that you bought it at 6 million. Better yet, you put 2 in. It's worth 6 when you buy it. You part of that 2 you put in as repairs, and it's now worth 10 million. If you pulled all that cash out and you're not on the hook on that loan, the money that you receive above your investment, so in my case, you put in half a million, you can get a $500,000 out without any tax ramifications. But if you touch the equity and it pays it out to you, the IRS treats that as long-term capital gains. Sounds weird, but you can't, the company can't have a negative capital account. You, as an investor, can. And if you do, then they look at you and say, that's taxable income to you if you take cash. They just don't want you levering the heck out of something. Now, if it's just you and you buy a property and you're on the hook for it and it becomes worth a whole bunch and you borrow off of that property, you lever it, that's fine. You can do that without any tax hit. Somebody says, do you not have to report the PPP on your taxes, the PPP loan? If you have forgiveness, no, it's gone. You're doing a form with the for forgiveness, but no, on the hook means you're a guarantor, Neil. So if I have a loan and the company borrows, let's say it's that same scenario, we all put in money, we put in 2 million, we buy a property worth 6, half of that is a loan, not half, in other words, we used 1 million down, we borrowed 5 million, we put $1 million into it, and now it's worth 10 million. And I only have a $5 million loan, then I'll have an extra, after all the cash I put in, I'll have some equity. I'll have at least 4 million, right? And I take that out and hand it to myself, and I distribute a big portion of it. Let's say I took $1 million out. I'm not on the hook on the loan. I'm not a guarantor on that loan. Then I would get my investment out, the $500,000 I put in, and the other $500,000 I received would be taxable as long-term capital gains. Not fun. All right, last question. And guys, we went way over. We're at 4:50. Sometimes I think we're supposed to be an hour, right?
Mm-hmm.
It's just too much fun. Why do these for an hour? I think we killed off some people though. We're like the Biden convention, like a Biden rally. Right? Everybody's going home. It's too early. You guys are up too late. It's 8:00 here. All right. What would you recommend as a business entity for a private music studio for instrumental education for maximizing tax benefits to allow deduct? You guys can already answer this. You guys already know. And I'm not being mean to Biden. Some of you guys are all mad at me now. No, it's just that there's a little bit of an energy difference at some of the different rallies, right? They're not quite as rambunctious. So there was one in Georgia he did today. Did you see him walking out to it?
I didn't see that.
Oh, they had some like folk music or something playing. And it was like he walked down the steps and there's like 20 people. They were kind of cheering, like, way to go, Joe. It's not a comment on his politics. I was just saying is that there's a big difference right now in the robustness of the crowds. All right. What would you recommend? We've already seen this. We want to have an employer-employee relationship. And in order to do that, so you can do all the reimbursements and everything, in order to do that, you need to have, from a tax standpoint, an S Corp, a C Corp, or a nonprofit. And on these guys, it could be an LLC taxed as an S Corp or a C Corp. And then you. If you're just getting started and you're making less than like $20,000 a year, maybe we do the sole proprietorship, but really, I wouldn't do it. I would do the CR. You guys are already getting it. How do you still alive? I am. You guys are mean.
You know, in this particular case, since it's for instrumental education, I kind of like the idea of the nonprofit.
That's actually a really good point. I love nonprofits. You sit there and nonprofits are great.
It still allows you to pay yourself a reasonable salary to reimburse your expenses and so forth, while having a charitable cause.
Somebody says, just want to make sure I'm okay when I retire, as I previously cashed out. Yes, I'm with you. I'm with you on that. This was going back to that DB. Americans need more money in their retirement plans. 40% are not say that they're not prepared. The vast majority of people going into retirement are actually dependent on Social Security. And as we don't be dependent on Social Security.
Yeah, and my guess is 40% is actually low.
Yeah. Well, 40% is who feels confident.
Oh, okay. I can buy
60% says I'm not confident. In the vast majority, it's a pretty high percentage actually depend on, like there's a lot of people that's their only retirement. Could very easily go away. Somebody says we'd like them. See, somebody says that they would like to be at a Biden rally because they'd have cookies and refreshments. That is just not nice. But I would go there if I had cookies. That would get me at just about any rally, as if you had good cookies and juice. All right, go to the podcast if you like this sort of stuff. Sorry to do that to you guys tonight. Here's your Platinum Portal. I like answering all the questions. I don't know. So food trucks, that's what we need. We need some food trucks. That's what I would do. If I was going to have a rally, I would just say that you got to have some beer trucks and food trucks, and then you just make sure everybody behaves. I'd go have a rally where all these folks have had to suffer all those fires and stuff. And I'd say, hey, guys. And then I'd hand out some cash to help them out or something. All right. That's the podcast. You go listen to stuff free. We've actually had some pretty cool podcasts recently. So I had some fun ones. Cookies and juice equals diabetes. Sugar-free cookies. You guys have not met my wife. She no sugar, and then if I eat a cookie, oh, she's mad at me. And I'm not exactly a skinny person, but boy, she's a fitness fanatic. She eats tilapia
Yep.
and yeah, she does the competition. So she likes doing the sugar-free is worse. You're not helping me. All right, anyway, so here's all our social media. And then if you have questions, by all means, go to Tax Tuesday at AndersonAdvisors.com. Send us in your question. If something, somebody says well-nourished, not chunky QRBs. Well, I'm a thick one. I am a thick one. Let's see, Tax Tuesday, visit us. If you didn't get your question answered, let us know so we can make sure. I do have people on it, but they don't get paid to answer questions. We try to get through them. We do it as a public service. I like to answer questions. And plus, it's good brain food every time we do these. See, somebody says, tell her that tilapia isn't good for her. It's the wrong omega. It's like eating donuts. Gary, she has a trainer that's always making her eat the really lean white meat stuff. I don't like tilapia because I think that they eat poo. No, they do.
It's not carp.
No, it may as well be. Like it's pretty gross. I'm trying to get her to eat more. Like I guess cod has too much fat. No tilapia. See, that's what I'm going to tell her.
I'm not telling Sandra anything because she's in way better shape than I am.
Yeah, she's pretty ripped. All right. So, and then you guys remember the tax toolbox is floating around out there if you want to grab on stuff. Toby's staff is underpaid. Michael, we always over deliver. If we say, there we go, wild caught salmon, they say that there's too much fat in it. Love that bison. That's probably what she should be doing. Anyway, we have to go there. Somebody says, if you had an installment sale right now with an option to accelerate, would you wait for the next administration? No. Would you? Yeah. So Emu is the best. Mark, it's because you're in Hawaii and Emu rocks and Ona rocks. Like you guys have some food over there that is the best. And you see, you're on Oahu, so you don't have Mama's Kitchen. I like Mama's Kitchen on Maui. I don't know why. That's probably like a tourist trap too, but I don't know. No tilapia, salmon isn't good. See, I'm going to tell you guys, I'm going to say it. Not Emu, Emu the ostrich. Oh, oh my gosh, you're eating ostrich? Mark, this is not nice. All right, fresh caught salmon. All right, guys, we've had enough.
Patty's about to cut off our internet.
We just say thank you, guys. Love Mama's Fish House. See? Yep. Hey, let's all meet at Mama's Fish House. That's where we're doing the rally.
All right.
Jeff, tomorrow at 5, we'll be at Mama's and have a rally. All right, guys. You guys have a good one.